Cameron Dawson, welcome back to On the Tape, round 3 now.
Round 3. Thank you for having me back.
The more things change, the more they stay the same, it kind of feels like here. We've been kind of stuck for a while here, and not just range bound, but just kind of the market trying to pick a direction. And I read your weekly, and for better or for worse, I pretty much always agree with it. So I don't know if that's a good thing or a bad thing for you. But kind of let's get into it, because I think the best place to start is we just finished Q1 earnings, basically. It's all over. Earnings came in a little bit better. Companies did a great job of managing. There was the haves and the have-nots, but the haves continue to get to higher levels that may be unsustainable, and the have-nots are kind of being ignored, so there'll be opportunities on both sides. So just your assessment coming out of what we came out with versus expectations, where we sit now, and then I'll ask you to talk about just kind of earnings in 2023 that seem to be coming off of kind of the low base of 190-200, creeping towards the kind of the 220, somewhere in the middle there, and just get your thoughts there and start with that.
Sure. I think there's a few things to take away from earnings season. The first one is that even though we beat on 1Q earnings, you didn't see analysts revise up their estimates for the full year, which is an implicit cut for the back half of the year. So it's interesting that you did not see this optimism bleed into the later parts of the quarters, which likely already reflected that the later quarters in this year had a big ramp in recovery and earnings already priced in. You have 9% growth already marked down for the fourth quarter of 23, and then another 9 to 10% growth for the full year of 2024. So that optimism wasn't increased. It wasn't tempered. It's been about the same. The other thing that is interesting from earnings season is that, yes, some names did have full year estimates revised up. Warren Pies on Twitter posted a chart back a couple days ago showing that just like the market breadth from a price standpoint has been really narrow, market breadth from an earnings revision standpoint has also been very narrow. So only the top 10 stocks within the index drove the entirety of the revisions higher, while the remainder 490 in the S&P 500 just sort of dwindled and have continuously revising lower. The last point to make on earnings season is one that's really interesting if you're a cyclical investor, which is that you saw big upside surprises to a lot of cyclical names, your cats, your deers of the world. Machinery, of course. There's other cyclical parts of the market like semiconductors. That's a bit of a different animal, mostly on today. But that what you saw is price reactions from a lot of these cyclical companies exposed to global growth was really weak and negative. So you raise earnings, and your stock goes down. That tells you that the market has already priced in the entirety of the good news, and that it's no longer willing to put a peak valuation on a peak earnings number. And so, yes, global growth can continue. Yes, there's potential for further upside revisions. But what you'll start seeing is those multiples start to get whittled down. That's usually the sign of a sea change in a cyclical change. When those stocks go down on good news, that's a sign of really a trend change happening in that part of the market.
So the sectors that kind of outperformed, consumer discretionary was very good, right? In the quarter, you saw, utilities were poor, right? They're not sexy. The consumer discretionary companies that have good balance sheets that weren't impacted by higher rates, right? That people can see they don't need to come back to the market for refinance, that have pricing power still to a degree. But it seems like even within those sectors themselves, consumer discretionary being one, we're seeing, retail bifurcation. Like we're seeing that happening right now. So are we going to get back to kind of a stock picker's market here? And it feels like we're close. When I see Abercrombie and American Eagle, which sit side by side in the mall, one performing and one not, and the investor community actually rewarding one and punishing the other, it gives me hope. I'm not saying that I haven't done enough work grandly on that, but Are we going to get back to this kind of stock picking?
I think we are there because we're in the part of the cycle where liquidity does become more scarce. Now, we can talk about liquidity that's actually has become more abundant since the beginning of the year. That's driven some interesting dynamics in markets. But when you get late cycle and cost of funds goes higher, availability of funds go higher, bank credit tightens, that does have a tendency to separate the men from the boys. That is the Warren Buffett proverbial tide going out. And so that's why we typically do see fading breadth at the end of market cycles, because you start seeing only the strong ones really able to keep up. I think you could even do it from an index level basis, which is look at how weak small caps have been. So we've seen small caps continue to underperform, and the takeaway from that part of the market is to remember that 40% of them are unprofitable, and they have more floating rate debt exposure than large cap, much more floating rate debt exposure, and a lot more absolute debt. So what that means is that they're more sensitive to higher interest rates, which is why even though we have all of this optimism in certain pockets of the market, small caps just sit out completely because they are still going to be the ones that truly feel the impact of softening economy, higher interest rates, and the potential for further economic uncertainty ahead.
So you mentioned liquidity, and you've written about it in your weekly piece here a little bit. Talk to us a little bit about that, because I think it has something to do with what happened in March with the regional banks, right? But it seems like that increased liquidity went into 10 stocks, not bank stocks, right? Not regional bank stocks either. It went into the 10 biggest names in the entire market. And if you look at the outperformance of the NASDAQ off the lows in early March versus, let's say, the S&P 500, it's really noticeable.
Yeah, I'd like to take you back to December of 2018. That was the origin of the birth of the big tech rally that took us through the end of 2021. And what happened in December of 2018 is that you saw a peak in real interest rates. Real interest rates were about 1%, and then over the course of the Fed pivot in 2019, and then the double down in the face of COVID, and the continued easing policy throughout 2021, you saw real interest rates go to negative 1%. That drove a massive, huge rally in growth stock valuations. So there's been a strong relationship between growth stocks and valuations, the PE multiples, and real interest rates, an inverse correlation. So high real interest rates, bad for growth stocks. Should be, until 2023. 2023, we've seen real interest rates go back to their highs. They're now at about 1.5%, and yet growth stock valuations are up 8 or 10% year to date. So what gives? How could growth stocks be trading at valuation levels that are now back to pandemic level bubble areas? So we are above the 2019, early 2020 peak. We're back in that bubbly territory. I think it's liquidity. And I think the source of the liquidity, and this is really backed up by incredible work that Dan Clifton has done over at Strategas, where he's created a liquidity basket of stocks and created a liquidity index to say, look, there's a strong relationship here, to show that growth stocks, the NASDAQ, long duration names, speculative names, all benefit when liquidity is becoming more abundant. But how could liquidity be becoming more abundant if the Fed's raising interest rates? They're effectively putting their foot on the gas and the brake at the same time. The source of this liquidity is coming from three important areas. The first one you mentioned, which is the response by the Fed to the banking issues. So opening up these lending facilities, and that increased the Fed balance sheet. They reclassified some of that, so now it's not impacting the balance sheet. But you do have the big repo facilities that are being used. That effectively adds liquidity. Probably the most important one, though, is the Treasury General account. And it shouldn't be lost on people that the last time we had an unexplained growth rally was in the summer of 2021, which also was the last time we were going into a debt ceiling, and we had a big drawdown of the Treasury General account. So what the TGA is a cash balance for the Fed. For the Treasury. And it's held at the New York Fed. When the Treasury spends money, what you have is it spends money, it goes into people's bank accounts, into reserves, and usually what happens is they issue debt, which sops up that liquidity. If they're not issuing debt because they're nearing the debt ceiling and they're trying to reduce how much new debt they're issuing, they're just spending cash. So you're not getting this one-for-one kind of neutral impact of issue bonds and spend money. So this has the net impact of increasing reserves, adding liquidity, and thus that's how we think you can explain this outperformance of growth stocks despite the fact that real interest rates continue to rise.
So from your seat, and you talk to a lot of retail people, and I'm sure some of the emails.
You mean that won't resonate with retail? It's so wonky.
Yeah,
yeah, I get it.
No, but I'm saying is that it's tough. You're everything you just said makes sense. I mean, those are facts. That's not, and stock prices and certain names are telling a different story. And for better or for worse, retail investors own these stocks, and they think that's the stock market, right? So to try to educate them, to try to explain and really warn them, or just give them the guidance to help them reflect, they don't care. Right? They don't care until they look back and say, what just happened? Oh, that's what happened? They don't even know what that is. So how do you dumb it down to people? I know exactly what you're talking about. Believe me, it hasn't paid to understand the plumbing of the system for a long time, because for 13 years, all they did was print.
Yeah.
And in hindsight, why even do fundamental analysis when the Fed's printing, right? Mm-hmm. So how do you guide these investors and just say, and I'll talk, right before we came on here, we were talking about, NVIDIA in general. We'll just use that as an example of a name that's in the news today, Dan. And the market cap today went from 750 billion to 950 billion, roughly. It'll be the biggest one-day move of all time. It'll exceed Apple's move from last year. So the incremental purchase of the stock from here, and I would argue if it had been at a 200 billion market cap, and I'm not long or short, I'm 200 billion market cap, would it have gone to 400 billion today? Would it? My point is there's no basis for valuation. So how do you tell people? How do you kind of guide them or warn them or help them to understand? Because you're not going to talk anyone out of it because you just got positive reinforcement. So
yeah, it does build on itself. And I think that there's a few things to keep in mind. We should always be very careful ascribing narrative to price action. And I think we talked about this the first time that I came on the podcast, is that oftentimes what people do is they see a chart that goes up or down and they find a narrative to fit that chart, when in reality, that's not at all what the driver is of why the stock is going up. It can be something like flows. It can be speculative buying behavior, or it can actually be due to fundamentals. It could be liquidity, a whole host of things. It's rarely the narrative that captures the zeitgeist or the hearts and minds of people. So that's the first point, is that when I talk to clients about getting exposure to big mega trends, we always have to talk about it on time scales, because I think the biggest danger you can make, and we can see this in any bubble, is people saying, it's okay, I'm buying the future. That's a problem if you price the entirety of the bright prospect of the future into today's valuation. So I think the easiest example of this is Zoom back trading at 80 times sales in 2021.
I was about to say Kathy Wood. I mean, the first person that came to mind was selling that dream, but keep going.
Yeah, who also sold all of her NVIDIA. So.
Yeah, amazing. You can't even make that up.
You can't make it up.
Yeah.
But when you price in the entirety of growth into today's valuation, that's where you have an issue for forward returns. Because what comes after bubbles? Crashes. Mm-hmm. The problem is bubbles usually last a heck of a lot longer and get a heck of a lot sillier than anybody expects. And we were talking earlier about the lesson, and I love this from Morgan Housel in his Psychology of Money. He talks about how the rationality of people participating in bubbles. People buying Cisco in 1999 at 150 times earnings, were they rational or not? If they had a 2-week holding period, they were pretty rational. They didn't care about the valuation because they're not holding it through the forward, the entirety of that time frame. But if people were buying Cisco because they thought it was the future of the world and the company and it was great and the internet and all this prospect, and they were going to hold it for 20 years, that was a terrible move. So I think that if you want to participate in names that have momentum and are going to the moon, it requires you to be more active. I call them Kenny Rogers stocks. You got to know when to hold them and you got to know when to fold them. So you have to make a buy and you have to make a sell decision. If you buy and hold and blindly say, I'm going to put this away for 20 years and everything's going to be great, you're probably going to look at your account in the midst of the run up to the bubble. You're going to get anchored to that valuation. And then when it draws down 50, 60, 70%, as NVIDIA drew down 50% last year, you probably are going to lose your cool and not be willing to ride out through that 20-year period. So I think that we have to be careful about narratives and we have to be careful about timeframes when participating in things that clearly have momentum that can feed on itself and not necessarily be based in fundamental reality.
You know, I love the example you give of Cisco, and there was a handful of names, Qualcomm, and I was just mentioning it to somebody else earlier. I had dinner last night with Jim Chanos, who's a friend of the pod here, a good friend of mine, and he was highlighting the similarity with what was going on with NVIDIA in the aftermarket as we were dining, and I was crying into my martini a little bit.
He was buying, I assume.
Well, no,
okay.
but yes, he was buying dinner. Yeah,
who needs olives when you have tears?
That's right. And there was nothing left. It was extra dirty, please, people. But he highlighted, Qualcomm, and he said, just go look at the chart from 1998 when it was $10 and it topped out. It had a massive blow off top in January of 2000, up near 100. Cisco had the same sort of formation. Now we know that Cisco lost 85% of its value. You could make the argument NVIDIA is a very different company. Microsoft, if you're, is up 3.5% in sympathy with NVIDIA today. Google's up a couple percent, right? So all the major players in this space are being dragged up. And so I get that. And to your point about trying to figure out when the bubble bursts, it can be a very painful sort of endeavor. But we highlighted last week on the pod is like, there were headlines that Steve Cohen was talking about how this AI thing is for real and he's getting long these stocks. Dan Druckenmiller, David Tepper. I mean, the list goes on. So this time it's the billionaires. It's the biggest, in the hedge fund class. And that makes me a little nervous. But I also know about all three of them, or at least two of them, that they buy into your Kenny Rogers mantra here. And so when you see a company like this that is up almost 300%, gaining $200 billion in market cap just today, I'm not sure any of those guys are out there buying right now.
It's like saying, hit me, and you have 20 on the table.
Yeah.
Right.
Kind of, right?
Yep.
That's a good one. Wow.
Which you would only do in a blackjack tournament if you knew that you had to get to the 21. But yes. Yeah, of course.
Yeah.
Of course.
But I forgot my sunglasses today, so I can't play.
You can't do that. No. Exactly. So your thoughts, I mean, just on that, everything Dan's really talking about in terms of, it's not just duration. But here's the thing. The FOMO is now in full gear. Like if there's 10 gears to FOMO, it was 9, it's 10 now. Because not retail, institutional investors that have been underweight, that have kind of, they chase in January a little bit, they chase in February a little bit. You had the sell-off happen. Like, I knew it. Now they have no choice, because as we get to the end of the second quarter and their numbers are going to be in the lower quartile or, wherever they're going to be, they're screwed. So their risk reward now is to pile in to these names. And so I worked in that business. I mean, I understand, and they're going to hold their nose and they're going to do it. And it's probably last in, first out in terms of what this is going to be. I know you talk to institutional people also.
Yeah.
So how does that conversation differ than when you're just preaching to retail?
There's a few things to note on the positioning front. If you look at trend following positioning, and Deutsche Bank published a chart about this a couple days ago, they're actually now at the same degree of exposure to the market, the same long degree of exposure to the market as they were in January of 2022. So they've gone from being very short to now being back long. And so I do think that we can't really make the argument that there's that wall of money for that part of the market. Other institutions, if you look at Bank of America fund manager surveys, for example, yes, we still have elevated cash balances. That's a terrible timing tool. We saw that back in 2008, that we actually saw the peak in cash balances about 6 months and 30% above where the market eventually bottomed. So take that with a big grain of salt. The other thing is that we are seeing big inflows into equities. We saw it last week. Citi published data, $21 billion into equities that they saw. And that was one of the largest weeks in the recent years. So you're right, the FOMO is alive and well. You also see big, huge call option buying on the QQQs, which just means that people are again experiencing FOMO. Put call ratio remains very subdued, which means that people aren't paying up for downside protection in the broader market. And so all of this points to is that for as negative as people say that they are in surveys, their positioning doesn't really reflect it.
So let's just talk about on the sector basis, though. You talked about small caps not trading particularly well down in the year. We know that banks are down in the year. We know that metals and mining are down in the year. Danny just mentioned, staples just dropped 8.5% over the last like 2 or 3 weeks or so. We have materials down the year. Retail is down on the year. I mean, there's a lot of parts of the market. Energy stocks are really bad. Healthcare, whether it's biotech or big pharma. I mean, the list goes on. And so when all those things that you just rattled off before are really interesting to me because they're chasing one trade. Right? They're tracing the trade that you said has an origin in Christmas Eve of 2018, right? When the Fed pivoted in a way. And that was the start of this thing. And then, we did have that quick drawdown in 2020, right? But then it was all of those names that reignited that bubble in a way. So to me, it's just like, it feels like the underpinning of the stock market are very reflective of what is likely to happen as far as the economic reality here in the US. And we haven't even talked about China yet, right? And it's like, have you seen what the Shanghai Composite has done in the last week or so? And so to me, I think back to that Q1 GDP print in China, 4.5%. They were doing nearly 7% pre-pandemic. It feels like everything is screaming that we are going to have this slowdown, that the consensus for S&P earnings is still too high. And I'm just curious, how do you square that in a way? Because something's got to give sooner or later. Either all the stuff that's been really weak is going to start to reflect an economy that's maybe about to turn up, or we're going to have all the things that are powering the major indices, right? They're going to turn down.
Well, and it's so interesting because the technicals, if you were just looking at the charts, you wouldn't buy any of those things that you mentioned that you look at the materials, you look at the energy names, the trends have deteriorated significantly. Look at copper breaking down, right, as a sign of potential for weaker growth. And then you go, okay, where are the places where I can actually buy good trends? If I'm just buying on technicals, and it's all those areas that we're going are extended. And
you know what's the best chart in the market, though? The SMH, the SOX, the semiconductor index. It really is. It literally, and when you look at the breakout today on the back of NVIDIA up 25% in Taiwan Semi, its two biggest components up 11%. That's if I didn't know anything, and a lot of you guys who listen to me each week probably say, "Oh, you don't know anything." But if I didn't know anything was going on, I'd buy that chart right now, like the SMH.
And it's funny because the technical analyst in me is would say just buy the momentum and ride it. Then the fundamental analyst says no, this is so extended. And I feel like it's like Christina Aguilera and Genie in a bottle, where she says, my head is saying let's go, and my heart is saying no. Like, what do you do when the only parts of the market are essentially defying a reality of what could be a future weakening? We have to remember, semiconductor stocks are extremely, extremely cyclical. And so if you have a recession, and I understand inventories are low today because we've already seen a big drawdown from all the pandemic disruptions, but you're not actually pricing in any kind of recessionary scenarios, nor are you pricing in a recession scenario into the broad S&P, as we talked about earlier with big earnings ramps. So eventually the gap has to close, just like eventually the gap has to close in the bond market, meaning that the Fed can't keep going out and saying higher for longer, and the bond market can't keep ignoring the fact that the Fed doesn't seem very eager to cut interest rates. And it's incredible how quickly we have seen the pricing of the next couple of months change in the probabilities. 2 weeks ago, we were pricing in the probability of a slight cut in June. Now we're pricing in a 45% probability of a hike in June and a 40% probability of a hike in July to capture that possibility of a skip. This bond market is still so whipsawy, it's probably still illiquid in some ways. The volatility is unprecedented. And so if all of these things can't be right at once, something will have to either catch up, meaning that you'll have to see other stocks catch up to the message that a handful of stocks are telling us, or that handful of stocks will have to catch down to the other 490 names.
Quick one. Okay, so CME FedWatch tool has, to your point, about a 50% probability of a June hike. That was 24% a week ago. The 2-year yield is at 4.5%. That at the start of this month got as low as 3.6%. So you talk about liquidity, and you're like, what the hell is going on? How did this shift so dramatically in such a short period of time?
It's funny because I was talking with Scott Wapner last week on Closing Bell, and we were talking about the probability of a rate hike in June. And I said, I think it's a 50-50 chance, and he practically fell off the chair. He's like, what are you even saying? I said, because look, the data's coming in better, and the data is not supportive of them backing off. And the Fed is concerned about inflation coming back. And yes, we've already known. People are talking about disinflation of goods prices. That started in January of 2022. It's been happening now for 18 months. So to price in the fact that now all of a sudden it's going to save us from higher rates. The other part of it is that if inflation moderates, but this remains a very tight labor market, why would the Fed be cutting rates? Because they're adding stimulus to an economy at full employment. They will be afraid at that point that they will create inflation.
Tony Dwyer, who's a good friend of ours, put out a note this morning about the soft landing scenario. So the market's starting to just price in soft landing, which he thinks is a bad thing, because in a soft landing scenario, the Fed's not cutting, right? Because so the market is kind of priced to perfection for a soft landing, to your point. And I watch Fed Fund Futures is how the market trades, period. I mean, it's the Fed. There's nothing really else on the margin. I think about if NVIDIA didn't report today, if they hadn't reported today, if it was tomorrow, the S&P could be down 30 or 40 handles right now, but because they did it, it's the market's up. It's the narrative of the day. To your point, how do you tell people to be very careful kind of, in these waters? And to that point, now we're getting this 20 days away, I think the next Fed meeting, right, Dan, or something like that, 20 days from now. And it's like, okay, Do I want the debt ceiling issue solved? Maybe I kind of want it pushed to September. Just kind of kick it down the road for 3 months, which they can do. Say, we're going to extend it. You can do these special things, and we're going to extend it. That's probably the best scenario for the stock market. Because one last thing, because inflation, remember we talked about this last week, Dan, on the show, CPI from a comp perspective is going to look very friendly for the next 2 months too. So I'm just painting a scenario where, give me a reason to sell the market versus, a reason to not participate or feel like I'm missing out here.
If we can believe for a moment that the source of the upside in the market has come from this additional liquidity that's come from the spending down of the TGA, there is a harsh reality that we're only at about $60 billion of it. So even in the TGA left, which means that you're kind of nearing the zero lower bound. So it can only go so low. It can't go negative. And the end result would be is that even if you kick it down to September, it's not as if you're going from $1 trillion in the TGA down to 60 billion. You still have you will lose that liquidity as a tailwind, even if you kick the can down the road. So, and then it just means that it could become a market issue in September. People have funding uncertainty. So I think the liquidity side of things is sort of an intractable, whether we have an issue with the debt ceiling and it causes a market sharp correction in the short term, or we have a placid debt ceiling and we get past it. The reality is, I think a key driver of this market will start to be a fading tailwind. Doesn't mean that you can't have further upside to stocks. It just has to come from the earnings line. It can't come from the multiple line because multiples are driven by liquidity. And they're already at the high end of prior ranges. And given the message that we're hearing from interest rates, probably they're not going to become your friend from a multiple perspective either. So I think that it's not to say you can't see stocks move higher, but if every name could print a number like NVIDIA, yeah, sure, the market could go to the moon.
Do you get a sense from your advisors or your advisors' clients that people are particularly worried about the debt ceiling not getting resolved anytime soon? Because going back to all those measures of kind of sentiment that you kind of rattled off before, again, the VIX just picked up from like 16.5. It got to maybe 20 briefly yesterday. It's kind of a little softer here. It just doesn't seem there's too many people out there who are too worried about a worst case scenario.
I think that it's very much a boy who cried wolf kind of response to things, which is that you've done this so many times. How many strategists have you heard come out and say, well, we've raised the debt ceiling some, whatever, is it 60 times or something like that, and it always happens. And yes, resolution does eventually happen. It depends, though, is how far close to or beyond the brink do you get in with a resolution, meaning that do you have a government shutdown in the near term, which is very disruptive, mostly to Main Street, not to Wall Street. Necessarily. But then what do you get as far as austerity on the other side? And do you get sweeping budget cuts that have the potential to be a drain on economic growth at the same time as you have a Fed that's still engaged in tightening policy? And I think that would be the key question coming out of all of this is, what does the deal look like? If the deal looks like big budget cuts, maybe great for deficit hawks, but what does it mean for global growth? And thus, what does it mean for EPS growth?
Here's my biggest problem in this market. When stocks do start to turn lower, and they will inevitably at some point, just the nature of it. And now when I say these stocks, I'm talking about the big boys, the things that have driving the entire market. There's 10 stocks that account for the entire market, basically, on their performance perspective. When they start to drop, what's the incremental buy point? Because it's not from a valuation perspective. It will be, but that's much lower from here. When that momentum starts cascading lower, what does that look like? And are they go back into staples and utilities and all the things that have been underperforming? Because inevitably, the rate cut will happen at some point, maybe be forced because these big stocks start to drop, and then it becomes, relative to where yields are going, staples and utilities look good. Is that what's going to happen here? Because it's been
quietly happening under the surface. If you look interest sectors, you can see signs of a bid towards defensives instead of cyclicals. My favorite personal one as a former industrials person is machinery has been underperforming waste stocks. So within a cyclical industrial sector, the fact that you have machinery names, as we talked earlier, you're going down on good earnings, waste stocks doing better, that tells you that there's already starting to be a bid for those defensives underneath the surface of this market. I think the other way to frame this is that if we look at the downside that we hit from a valuation perspective in June and October of last year, we bottomed each time at around 15.5 times earnings. Right now, we're trading at 18.7 times earnings. So to your point, there's a big difference between those two. Do we triple bottom in valuations? I don't know. I think it depends on the degree and the magnitude of the recession. If it's a slight recession and you have the Fed step in fairly quickly and stabilize things, you don't have to go back to those valuation levels. But if you have the Fed be a bit trigger shy and say, oh, no, we're not coming in to bail you out and save the day, then I think going back to the valuation levels we saw last year is very much possible. The last part of it is that that means that we don't go to those dire valuation levels that you saw back in 08, 09, of course, as well as even the lows that you saw in 16, 2018, 2020. It's maybe a higher base, and you can satiate the people who say, well, it's just index constitution is different, so that's how we can justify it.
Well, it's interesting. And the index constitution, you just mentioned that we bottomed in October at 15 or so times. And if you look at just kind of the equal weight S&P, it bottomed lower than that. It bottomed at the sort of multiple that you would expect to have, right, at a cyclical downturn like that. So I think that's really important. But I guess where we get caught up, and we track our main man, John Butters, over there at FactSet Earnings Insight blog, his work, and he's saying the S&P right here at 18.5 or wherever it is it is basically in line with the 5-year average, and it's slightly above the 10-year average, about 17.3. But then you go and look and you see where the average 10-year yield has been over that 10 or 5-year period, and that makes no sense.
And that 5-year average also has 2 years of being in a bubble in it. And I still hold that the 2020-2021 period was a bubble. And from a broad market valuation standpoint, because the last time you saw valuations on a next 12-month forward basis go into that 20 to 23 times, which is where we traded in the S&P 500 on a next 12 months forward, the only other time we did that was during the 1920s bubble and during the tech bubble. And this time around, we had a huge liquidity boost. You were growing the balance sheet by $4.5 trillion, and you were having real interest rates at negative 1%, as we talked about. You had money supply growing at 25%. That's how you get to 20 to 21 times on that basis. So when we think about anchoring to those levels, sure, we can go back up to those levels, but I have to count on having liquidity be that abundant to justify me trading there. And that's where I struggle in just anchoring to the 5-year average, because you're including a bubble.
I think about it a little bit differently. I think about the out years. I think about who cares where it's trading today? But if 2 years from now, what are the earnings going to look like? 18 months from now, what are they going to look like? And I think they're flat to lower. I mean, that's just what I believe. And if that's the case, then, but let me rephrase that. If that's not the case and I'm wrong, Fed's going to 6%, 6.25%, 6.5%, because in order for earnings to grow, the economy has to be humming still. And if the economy's humming, Fed's not going to be coming and cutting rates. It's not going to happen. And we're going to continue with QT. And we're going to continue with all this. And it doesn't matter right now. I guess my level of frustration has been, in the 3 times you've been here, each time, and that goes back to last year. I thought, here we go. We're right at the no, seriously. And,
I'm like Tippi Hedren from the Birds.
No.
Wherever I go.
But I'm in the same camp you are. I'm like, but the next time we see you, we're going to be talking about, but I think people paint us, and when I say us, Guy who's with us, and I'll paint you and Dan, it's not being bearish, it's being a realist. And try to being realistic just comes across as bear, because that's what the market's giving us right now. And yeah, I'll miss out on all of this. I'll miss out on the chase. I'm willing to miss out on it, because I'm not going to be the craps table and spread out on 4, 5, 6, 8, 9, 10, pass line combats all over the place, full odds, and go out. I'm taking them down right now, off the 4, off the 6, off. I'm taking things off right now, and I'll live with that. You know why? Because I can go get 5% risk-free, basically right now. And that's the part, to me, where I see this background. To the point you guys just made about where are yields versus that risk-free basic return, if it is risk-free, that's what makes no sense to me, is that.
I wonder if the answer to all of this problem is is maybe to keep a phrase in mind. So I'm from Orlando, and there used to be a liquor store near my house that would say, lower your standards for more options, which was great advice.
Great. Yeah. I was going to say it doesn't say that when you're walking out the door.
No.
Okay, good.
No.
Right, okay.
So, but I think maybe the phrase that we should keep in our mind is shorten your time frames for more options, meaning that markets can trade on momentum and positioning and FOMO in short time frames, but it's not enough to sustain breakouts. And I think that what you do is you keep that valuation discipline, you keep that earnings discipline in the back of your mind, knowing that, hey, trends might be strong right now. And if I trade up above, we saw NASDAQ peak back in 21. I think it was 18, 19% when it traded above its 200-day moving average.
18, 19% or times?
18, 19% above its 200.
Oh, okay, gotcha.
Above its 200 days. So it gets extended versus trend. Maybe that's some time to lighten up. And so I think that if we think about shortening our time frames, then you're in this period that might defy reality. And you can participate, but knowing that you have a negative volatility alert, you probably should pay very close mind to that.
All right, 3 times the charm here, Danny. I think so.
I think the 4th time is going to be the charm.
4th time is going to be. Hopefully, like you and I will be right by then.
Right.
How's that? No, but
how much you want to bet the market's still going to be at 4,100?
Oh, exactly.
I think it's been
It's really crazy.
Killing us here a little bit. I mean, listen, here's one of the things that's kind of interesting, and I'll just end with this. Is I'm bearish because to your point about what I see in front of me, right? And the markets oftentimes don't make a whole heck of a lot of sense. And I'm not wishing for worst case scenarios. I don't want to get my retracement down to 3,600 in the S&P 500 because we can't do the things that our elected officials are supposed to do, like raise a debt limit and come up with sensible budget, negotiations and all that sort of stuff. I just want like a little realism to work into the market about all the things that you've just so succinctly laid out here. Is like there are a lot of headwinds, and it does seem like with a $220 consensus for S&P earnings right now, that doesn't seem particularly realistic in this rate environment, especially with what we're seeing as far as the headwinds to growth. So I guess take us out with Cameron a little bit, like what could go right here? You know what I mean? Because we spend a lot of time trying to pick at what we think is a universal bullish consensus, but what could go right where, and maybe it is a soft landing scenario where, a recession is, Danny's like,
I don't even know. I can't wait to hear the answer.
Yeah,
I want to know.
What could go right?
So I think what would have to go right, the first step is that the market would still have to ignore interest rates. I think that's step number 1, because what step number 2 is in order for earnings to reaccelerate and grow well, you need to see higher inflation. Inflation is very, very good for corporate earnings because corporate earnings are nominal. So nominal meaning that it's not a real number. It benefits from inflation. And when inflation is high, it gives companies pricing power. That was the source of the earnings beat this quarter. If you look at consumer names, they go, oh yeah, we still raised price and consumers accepted it because inflation's still high. So if you saw inflation stay high, that drives strong top line growth, that drives strong incremental margins, and that would then allow you to have margins rebound back up to those pandemic level highs, which I think they were over-earning because of inflation and because of pricing power. But if you have inflation coming back, then that can continue. I would say, though, the caveat and catch in all of this is that at $243 a share baked in for 2024, you already have margins going back up to those pandemic level valuations. So to your point, Danny, is that there is potential that because of the over-earning in this inflation dynamic, if it really does abate, if inflation slows, then you could see earnings kind of flattish and sort of just grow into the reality that they over-earned during the COVID era, and that pricing power is going to go back to the time of kind of the great stagnation. So that's the bull case. Higher inflation drives higher earnings growth, but it requires then that the market continues to ignore interest rates because that's the scenario where the Fed stays very tight and continues to raise rates.
All right. Well, as we kick off Memorial Day, have a great summer. We will see you probably here right after Labor Day. We'll talk about the summer. We'll talk about where the market was. I have a feeling the 4th time's a charm. This time we'll be coming back with a look back and see, what happened here, which I think, unfortunately, for a lot of people, I think you're going to be correct. But we'll see what happens. But Cameron, thanks for coming on. Really appreciate it. Thank you so much.
My only goal for the summer is to be tanner than all 3 of you.
That might be tough in my case. But
well, you better lower your expectations if that's what you're doing. All right, Cameron Dawson, thanks for coming back.
Thank you.